Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, we got some breaking news for you. TikTok is officially facing a ban in the United States. This comes after the appeals court refuses to block the law that would ban TikTok. Now, the whole idea is to force a sale of TikTok here in the U.S. from ByteDance to an owner in the United States. Whether or not that happens is definitely a big question mark. Lots of question marks around this. First of all, will Trump stand by this, or will he oppose the ban and then complicate its enforcement? If it was to spin off and if someone were to buy it, who would that be? What would the numbers look like? But either way, you take a look at Google and Meta. Meta, arguably one of the competitors, right? Because they have Instagram. That stock up over 2% on that headline, Paul.
Yeah, this is big news in the world of social media, digital advertising. Meta again up 2.2% today up to a 52-week high. But boy, TikTok has become so big so quickly in terms of number of users, their total audience, and the advertising they generate, and the retail e-commerce that they generate, just in a handful of years. Become absolutely huge. Now what did they do? Now what does ByteDance do? The owner, again, the Chinese owner of TikTok. And again, what does President-elect Trump do, as you were talking about earlier? I'm not sure really his real position on this.
So just for some background here, the law was signed back in April. It did have bipartisan support, and it was to force a divestiture from ByteDance of TikTok here in the U.S. Now, then, of course, there were lots of lawsuits, etc. Now, leading American investors like Sequoia Capital, General Atlantic, and Susquehanna own significant stake in TikTok's parent company, ByteDance, and that's collectively worth billions of dollars. So that also then complicates the issue with President Trump-elect in office as well. Now, ByteDance was trying to get it overturned, saying banning the app is unconstitutional. So let's get more here with Matthew Schettenhelm. He covers this he's a media litigation analyst for Bloomberg Intelligence. All right, are you surprised?
I am not surprised. This is what we expected coming out of the September oral argument. It was a tough hearing for TikTok. What we haven't seen yet, and it just popped up on the docket, is the opinion, the reasoning from the court. And it looks like there's a concurring opinion from at least one judge, but I haven't been able to read the decision yet. But this looks like a loss for TikTok. That's what we expected, and that means that if it wants to stop this ban before January 19th, its only realistic option, I think, is probably going to be to go to the Supreme Court now and try to ask the justices at the Supreme Court to hit pause on that January 19th date.
And what typically how would the Supreme Court respond to that type of request typically, given this ruling here?
Yeah, so I mean, you go on what's known as the shadow docket at the Supreme Court, where the court looks at emergency relief, and the thing is, it's hard to get that. You usually need 5 justices to vote in support of it, and so there's a risk. And again, I want to read this decision, but there's a risk, I think, for TikTok that the justices say, look, the D.C. Circuit got it right. We don't really need to get in the way of this. On the other hand, this is potentially a major First Amendment question, and maybe the justices say, look, this is so important, let's hit pause on that January 19th date so we can take it up, and then they'd probably decide it by June of this year if they're so inclined.
Okay, so let's pretend that we move forward to January 19th, right? And that's the date where it would be banned. So if my kid's on TikTok, which she's not, does she automatically can't get on it? But if she goes to Mexico, she can access TikTok? Is that what I'm looking at?
Yeah, so yeah, on January 19th, the way the law works is it doesn't strip it off of everyone's phones on that date. The way the law works, it says that as of that date, any company that carries the app in its app store or that carries TikTok on servers in a way that allows the app to update no longer can do so. If they do so, they're at the risk of gigantic penalties. It's something like $5,000 per user. And so if the DOJ is willing to enforce it, which is going to be another question, President Trump, potentially could tell his DOJ, look, don't worry about enforcing that law. But if you're a company that carries TikTok in your app store, are you going to take a chance that President Trump is not going to enforce something that could reach billions of dollars in liability against you? I'm not so sure.
What do we know about President-elect Trump and his administration, how they're viewing this particular issue? Have they opined on this yet?
Yeah, well, so Trump's been back and forth on this issue. So President Trump was the first one to propose a TikTok ban, and his administration moved ahead with one, and then fell in trouble in court because he tried to do it himself without Congress. Then this time Congress did it and passed it. President Biden signed it, but then Trump reversed himself, and now Trump has said publicly, "Look, we don't want to help Meta. I don't support a TikTok ban anymore." The problem is it's already law. It's already done, and I think it's a difficult thing for him to convince Congress, which passed this on a bipartisan basis, to reverse itself. And so his only options would be kind of the unusual course. Oh, we're not going to enforce a law that Congress just passed, or or approving some sort of sale, a divestiture. But there's no indication that China would allow that sort of a divestiture.
All right, really great stuff. Really appreciate it. Thank you so very much for jumping on with us. Matthew Schettenhelm, media litigation analyst for Bloomberg Intelligence. And then, of course, TikTok is a really big customer of Oracle. What does that mean for Oracle?
I see what
Meta has Instagram. Is that good for Meta, etc.? So going down that rabbit hole as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
And a lot of economic data popping out today, leading off this morning at 8:30. Change in non-farm payrolls came in at better than expected, 227,000 versus a consensus of 220,000. The revision from the last month was from 12,000 to 36,000. So some good numbers there. Tom Gimel joins us. We always love to check in with Tom on Jobs Day. Tom is the founder and board member of LaSalle Network, one of the leading staffing and recruiting firms in the country. Tom, pretty solid number. What'd you take away from the non-farm payroll data?
Well, number one, I'm not wearing any Sephora or Lululemon at the moment, so I don't know what that means.
Thanks for clarifying.
Yeah, want to make sure we're clear on that. But no, you guys know when we're putting up over 200,000 jobs, you know how I respond, that things are great, and we've got to look at that as a very strong positive. Average hourly wages up a little bit. Average hours worked up a little bit. Revisions were not bad. That's a good thing. Everything is pointing positively. I really hope that the Fed does not lower interest rates. I don't think we need it. I think it's something we're going to need the dry powder in the latter part of next year, and to make sure that we realize this economy is going really strong. And with unemployment inching up, that's exactly what everybody's been saying. We need to curb inflation. So
the counter to that is the household survey being a lot weaker. What did you make of that?
Listen, I think that if we're looking for areas of weakness, this is why economists have jobs. They're always going to find some number that goes against the grain of what everything else says. My feeling is what we know is factual. More people are working. Unemployment historically at 4.2 is still very, very low. And unemployment is going to go up. Why is it going to go up? Because of Doge. Is when we do that, when Musk and Vivek get in there and we shed government employees, they are going to file for unemployment, and they don't automatically convert to the private sector. And so we're going to have a situation where I believe unemployment is going to go up naturally, and we're going to need to be able to have that lever to pull of lowering interest rates, and we don't want to use it now.
Average hourly earnings on a year-over-year basis up 4%, a little bit better than the expectation. What's the wage environment look like?
Hold on. Look, think about that for a second. If somebody gets a 3% raise as a cost of living increase, a cost of living adjustment, COLA, we say that that's what corporate America does all the time. We're talking about 4% average hourly earnings year over year. That's a third better than what average increases are in corporate America. I think those are really good numbers.
Inflationary for you, or is this just, again, a healthy labor market?
No, I think it's a little bit of inflationary, but we're looking at, what we still have. We all go to restaurants. We see that there isn't enough workers, and even though that's where so much of the hiring was done this past month, and going into the holiday season, you're going to have more of that. There's a lot of positive feelings, whether you like the results of the election or not, that it's anti-regulation and it's really pro-business. And so companies are going to be hiring and wages are going to go up because in order to get people for the jobs that are in demand, i.e. service jobs, or to get people to leave in white-collar jobs, you're going to have to pay more. And it's going to increase that dollar amount. But I think, I want to repeat, when we get more federal workers who are filing for unemployment, that number's going to go up and you'll see the inflation come down naturally.
Yeah, that's such a good point that we forget that's coming at some point over the next few years. Thanks so much, Tom. Really appreciate it. Tom Gimbel, founder and board member of LaSalle Network.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to the economic data of the morning that, if I dare say, Goldilocks job report. Jeffrey Cleveland is chief economist over at Payden & Regal, and he joins us now, as he does every Jobs Friday. Hey, Jeffrey, is this a Goldilocks report? Can I say that, or is there another word I can just use to describe this?
Yeah, Goldilocks, soft landing. I think both of those phrases work. You've got decent headline job growth. The 3-month average, I think, was 190,000. The 12-month average was 190,000. The 3-month average is around 180,000. So that's enough, I think, to keep downward pressure on the unemployment rate. So that's good. There's probably enough concern about the unemployment rate ticking up, like it did in the report, to 4.2. So from a risk management perspective, I think the Fed, keeps on cutting. So we get a cut in December. But there's no evidence of a recession here. So you've got, a continued economic growth, no recession, and a Fed that is going to continue to cut rates over the next 12 months. So I think that's Goldilocks. That's great for risk assets.
Great for risk assets. That's kind of where I was going to go, Jeffrey. I'm just wondering how you think our Federal Reserve is going to view this data here this morning before their December 18th meeting.
Well, they're tasked by Congress with keeping us at full employment, Paul, right? So, they want to keep that unemployment rate low. They don't want to risk that it continues to tick up. So I think that's top of mind. The only thing preventing them from focusing on the labor market was inflation. But I think inflation is cool. If I could give a pitch for the Payden & Regal chart of the week out this morning,
I guess.
we looked at market-based core PCE. And that looks bang on with the Fed's target. It's running at about 0.2% month to month for the last 4 or 5 months. So that's good enough. Inflation is back to target. So focus on the labor. So I think that keeps the Fed cutting, Paul, at the December meeting. We can debate about how much they really need to cut next year.
Yeah.
They could probably afford to go more slowly, sure, but cutting they will.
So, Jeffrey, here's the counter. So Tom Gimbel, we just talked to him, founder and board member of LaSalle Network, was talking about the fact that once the DOGE office, so the Department of Government Efficiencies, just slashes government workers, all those people are not going to be going to the private sector necessarily, so the unemployment rate will rise. And the Fed's going to need a lot more dry powder to combat that, which means that maybe they don't need to hike anymore right now. Cut anymore right now. What do you make of that argument?
Well, I think from the Fed, a central banker perspective, they're going to say, well, we're going to wait until we see the actual details of any plan to slash spending or cut payrolls. So until we see that, we have more definitive details. That's not going to alter the Fed's plan. The Fed is going to look at what's going on with their trajectory for growth, the unemployment rate right now, and inflation, and then make decisions based on that. My only thing on this DOGE thing is that a lot of the government employees are at the state and local level, not as many at the federal level. So I wonder how much you could really slash and burn there. So that might not. I think once people get into office, they might realize the details. Reality is not quite what they thought it was, and they might be more difficult to make cuts. However motivated they are to make cuts. So I think that's an issue here. We'll have to see how this plays out. TBD. Jeffrey,
so we get this pretty solid labor number here. How do you view the U.S. consumer? It seems like the U.S. consumer, if he or she wants a job, he or she has it, and wages are going higher, pretty decent.
Yeah, I mean, average hourly earnings ticked up, Paul. You saw that, so that's good. So for us, Payton and Regal view on consumer is look at income growth. If the consumer in aggregate continues to have income growth, sure, there's always pockets of weaknesses, but overall, aggregate income growth is still humming along at 5% year on year. When you account for, what people are being paid and how much they're working, how many people are working, that looks excellent to us. That's the reason why, Paul, in the last 8 quarters, U.S. GDP has continued to be 2 to 3%. Consumer spending has continued to pump along, and it's because of income growth. So I don't see anything in this report that alters our view on that. So that's one of the reasons why we remain bullish on the U.S. economy. All
right. So you think the Fed's going to cut then in December? This is all fine enough to do that. Then what, as you raised?
I think, the argument that central bankers would make is that as you get closer to neutral, where you think you'll kind of settle in, that you can slow down. So as you approach the intersection, if you will, Alix, you maybe take your foot off the gas a little there in your car. You slow down, right? Yeah. Some people just power through. I don't know. But I think that's what they'll do. So, right now we have penciled in 4 cuts next year, so 1 per quarter. I think that's a decent starting point at this juncture. And as you know, we've been talking for a while now, I've been hawkish most of the last 3 years. I'm more worried about inflation. So I think this is a sign of Payton, being nimble, not being dogmatic. The facts have changed. Inflation has cooled. So the Fed will be cutting over the next 12 months.
Jeffrey, thank you so much for joining us. Always appreciate getting a few minutes of your time, particularly on these jobs days. Jeffrey Cleveland, he's the chief economist at Payton & Regal. He's out there in LA joining us via Zoom here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the themes that Alix and I like to stay on top of on a kind of a continuous basis is commercial real estate in this country. It had such a challenge like many other industries and people did during the pandemic. It's recovering. Different parts of commercial real estate recovering at a different pace. One of the ones that's really, really tough, and particularly for those in larger markets, is office real estate. Lisa Nee joins us here. She's a managing partner and head of real estate at Eisner Amper. She's here in our Bloomberg Interactive Broker studio. Lisa, talk to us about the office real estate market. I've started to see some stories about some marquee properties in top 10 markets starting to trade. That's the good news. The bad news is that huge discounts, 40, 50, 60% discounts to pre-pandemic levels. Where's the office real estate market in this country, do you think, today?
Well, thank you for having me. So the office still remains at, if it's Class A, those properties are still faring very, very well. Okay. So it's trying to see what sectors in the market and which type of classes of properties. So some of the Class C properties that you're going to see, that's really what a lot of the things you're reading about. I know you just read about some stuff this week in the New York City marketplace as well for office. And so looking also when people are, is this ripe for the conversion to rental? What are we going to do with this? What is that office? And how much money does it take to actually go in and either take out the loan or even fix the property? And so office is still going to remain a little bit, the CMBS report came out that it was a 10% delinquency rate, which is pretty high for office. And they were slated that they expected that to happen months ago. So it's taken a while for the delinquency rates on the office to generally creep up there. But I think people are still looking at it as a little bit of a concern and looking to sort of say where are the opportunities out there, whether it's the conversions, whether it's now time to retrade and think about repricing the office market. Hopefully, there's going to be somewhat of a mandate for return to office, although we look around, this place is always bustling, but there are a lot of offices that are still quite empty. And how are employers going to be mandating those?
So for the Class C office space, what happens to those buildings?
Class C?
Class C, what did I say?
Yeah, C. But that's not good, right?
Right, but yeah, what is that? Can you give us some broad examples of what that would look like, and then what happens to that real estate? Yeah,
so that would be older stock that could be in Manhattan or in any city around the country that probably needs a lot of work to renovate it to get it to where the amenities that you guys have, such as Bloomberg or some of the even where our offices are now. So people are looking for those amenities to get them to a Class A building. That's a lot of capital that needs to be infused in that. So people want that a little bit more of an experience in the office. There's more focus on health and feeling good about where you are. Those Class Cs, are probably 40 to 50 years old and don't have that feeling and that look.
But that, I'm thinking anything but Class A in this marketplace in New York City. I'm thinking that's 70% of the square footage. I mean, it's a ton. I mean, look at every building up and down 3rd Avenue, every building up and down Lower Park Avenue. Like Park Avenue, just above Grand Central Station, was in the news this week. I think, that got marked down below the value of the mortgage. I mean, there's so much of that square footage in the city. Nothing's happening to that stuff. You can't renovate that stuff, can you?
So a lot of it, so you're also looking at external renovations versus internal, and recreating that space for the tenant experience. And so a lot of it can get changed internally for the tenant, and even the lobbies. So yeah, you're not going to have the glass windows and the beautiful outside facade, but interior for the tenant improvements, you can make those changes to make it more palatable for the consumer to use that product.
But again, to your point, it's still expensive to do that, and also we don't know what the return to office mandate is going to be for that to do. So what's like the next solution? So if there's not the money to kind of renovate it, right? Does it just go to the bank? Does it go belly up? What happens to it?
So we read there's two large developers in New York that are taking a platform. They just started a fund nationally that they're going to convert some of these office to residential. Now, we've been reading about this a lot, and you'll have a lot of people talking about the negatives to positive, but these are experienced developers who have already created some of that conversion from office to residential. So not all of the stock will convert, but some of it will really, really successfully with the right developer, and that's a really exciting thing, and that would be across nationwide. It's not going to, again, it's not a 100% solution, but it's a really nice type of solution for those types of assets out there. What's
happening with, commercial real estate mortgages as they mature, and now I gotta come back and rates are so much higher and my loan to value ratio is all screwed up now, so I need new equity. What happens to those types of situations? What are we seeing out there?
Yeah, so we just saw this past week, Valley National sold $1 billion portfolio of their loans to Brookfield. And so those are positive things when sales like that can happen.
Did they sell that at, I'm assuming
it was a very slight discount. So that's
slight. So this was good?
This was good. And, and Valley National is going to retain servicing those loans. So they just really wanted it off their balance sheet, and Brookfield's going to take that over. Deutsche Bank, the $1 billion portfolio of theirs, which was unique, and why that's good news, is that that portfolio had a lot of office in there. Mm-hmm. So the fact that that was able to trade and close, that's really optimistic when you look at it. So have we reached our floor? Or are we in a stable environment? Looking at those $1 billion transactions, one of those would have been a highlight reel from the news. 2 happening in a week, or 3 even happening in a week. That shows that there is movement and that there is some activity there. To your point on rates and what's going to happen, we think the Feds are going to cut again this month, and so consumers are looking on the sidelines and figuring out the money's out there. It's just nobody likes the prices and the rates.
Right, of course.
But the money's there.
Yeah, you just gotta get the bid to ask. You gotta get it just to come in, and how long that winds up taking.
Correct.
Before I let you go, how's Boston right now?
So interesting. Boston is an interesting market when you look at it. We're reading about it in the papers. It's a little bit slower to get back to where some of the other cities are doing. I went to school in Boston, so it's got a close to my heart, but it is a little bit slower to get back both on the residential and on the office commercial side to where some of the other cities we're seeing have rebounded a little bit quicker.
All right, good stuff. Lisa Nee, thank you so much for joining us. Lisa Nee is a managing partner and head of real estate for Eisner Amper, joining us here in our Bloomberg Interactive Broker Studio. I like to think we're in an A or A plus.
Oh my God, yeah.
Totally,
we're like
right?
A++. Everyone's jealous of our snacks. And
I
you
know.
should have seen it, Lisa. We had a whole Christmas fair the last few days.
Yes.
It was jamming upstairs.
It was.
The snack flow was unbelievable.
So yeah, Bloomberg, they figured out this get people back to the office kind of thing. So it's all working out.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.